Welcome back to Tampa Real Talk with me, Gavin Frater. We are in week 4, and so what do we want to cover today? Well, today we're going to cover what your bank won't tell you about buying in Tampa right now. And look, I'm not saying that they're hiding secrets from you, but there are definitely things you need to know when you're getting into a real estate transaction that the big banks just don't want to tell you. And I'm talking about your Wells Fargo's, your Bank of America's, your Chase, those big faceless corporations where you don't actually get to speak to a real person. No. I talk to buyers every single day who've been told that they can't afford to buy right now. Look, sometimes it's just the wrong lender, the wrong advice based on the wrong information. And so today I'm bringing in a trusted partner who's going to change how you lot think about what is actually possible and what the banks aren't volunteering up to you in advance. So, Mike Longman is going to come on in just a couple of minutes. And Mike is fantastic because he is a traditional Jersey guy. And I'm not saying that that's a bad thing for Florida guys, but he's a no bullshit. This is what you need to do. This is what I'm going to do for you. And Mike will go to bat to make sure that your client or you, the person who's looking to buy a home, gets into the home that you want. No, if it means he's got to yell abuse at somebody at a faceless call center, he'll do it. I've seen it. I've heard it. It's not pretty, but it's effective. But look, the reason that I work with the professionals that I work with is because they get the job done. Mike is not going to be the guy who sits there with an arm around you and makes you feel better about your shitty credit, but he is the guy who's going to tell you what you need to do to make it better. He's not the kind of guy who's going to send you milkshakes on closing day, but he is going to reach out to you when rates drop and said maybe it's a good time to refinance. Mike is just a good guy at what he does, and that's why I wanted to bring him on first as my first guest on this new podcast. So what are we going to talk about today? Well, we'll find a little bit out about Mike, what he's been doing, how long he's been doing it, and what he loves about it. We'll find out the mistakes that most buyers make when getting into a mortgage situation. We'll talk about the obsession with rates. We'll talk about what people can qualify, where they versus what they should be paying. And yeah, look, we'll touch on last week's episode, which is the pre-foreclosure mortgage angle and how that will impact you going forward. Sit down, strap in, because this is going to be one hell of an episode. So, guys, this is our first guest here at the Tampa Real Talk. We have Mike Longman, who's with us from Crown Home Mortgage. Mike, thank you very much for joining us.
Thanks for having me. How are you?
And look, Mike is a Jersey guy, as I said in the introduction. But Mike, you've been down here a number of years now. Why don't you let people know a little bit about you for those who don't know you already?
Sure. So I've been in the mortgage industry for 25, going on 25 years. Yeah, going on 25 years.
Wow, you joined the mortgage industry when you were 5?
Yeah. About 4.5 actually. Yeah, I was growing up. Most of my career was up in New Jersey, Pennsylvania. I've been down here for 8 years. Did like what a lot of people do, real estate and mortgage wise. They figure I'll move down here and I'll keep my business up there and build some new relationships down here. The market was just so different down here, and it was just so hot down here at the time that 95% of my business now is down in Florida. I have a handful of New Jersey agents that I deal with, but most of it's all down here. Just love the Florida lifestyle, really. I mean,
So the question I would have for you, obviously, as a New Jersey guy from a real estate perspective, I see some significant differences in how my business runs on a day-to-day basis. From a more regulated industry like mortgage, do you find that everything's the same in New Jersey down here in Florida, or are there differences that you had to adjust to down here as well?
there's a lot of differences because I was North Jersey, so it was an attorney area, where down here is a title company area. So speed is it's a lot faster down here. Things close, 20, 30 days down here. We're up north, 45, 60, 45 was fast in New Jersey. Like I remember back in the day, 45 was like
Well, if you've been here 8 years, then those COVID years, we were getting them down to 28, 21, some of them. So they were getting fast, but obviously you were waiving a lot of the in-person stuff because nobody wanted to touch anybody.
Yep. Yeah. So, Florida's just a little bit different. I mean, the houses are a little bit more cookie cutter, I feel, down here. When you get closer to the water, there's some issues, but up in New Jersey, everything was built in 1950, right? You don't see that down here. I mean, if it's 1991, it's old, right?
Our New Jersey home that we sold was built in 46, and we bought it off the original owner in 2013.
Yeah.
So.
It's Yeah, it's a great place to be. It's a great market. Different markets now. I mean, we have a ton of inventory down here, and things are still zipping off the shelves up north.
Well, let's talk about that because obviously things do still zip off the shelves. Open houses are still highly attended. How do you see the biggest shift that you've seen over the last like 12, 18 months in the Tampa market? What are you seeing as far as whether it's applications, people who decide to wait? What are you seeing on a day-to-day basis in the mortgage world?
I think a lot of people are still buying. It's just we have a lot of new construction, right? So we have up in New Jersey, where I was from the Rockaway area, um, Andover, Sussex County, up that way, and there wasn't a ton of new construction up there. We're down here, like you as a realtor could drive somebody around that I have pre-approved and looking at pre-existing homes and show them 30 of them, and then all of a sudden you see this new development, and you're like, let's just go check one out. And it's like going into a car dealership. It's shiny, it's new, right? And they got some good mortgage products out there, the bigger builders. So people are buying, but a lot of people move over to that new construction area, which is great, right, for them. But
Yeah,
we
I
really don't
think
get
with I
those.
think definitely if you look at areas like Wesley Chapel, Plant City's seen a big
Hmm.
increase in new builds. Wamama, oh, what's it called? Parish.
Yeah,
They all have
Palmetto
a lot of new
Parish.
build developments, and it's going to be hard to compete because we get emails from them from the real estate side, like bring us your buyers. We're offering 4.99% when the standard rate is what 6.5 right now,
Yeah,
and we'll cover your buyers' closing costs. So it's like it's going to be really difficult from your perspective to compete with that kind of market.
yeah. My daughter just bought a home down in Fort Myers, like 2.5 hours south, or 3 hours, I guess, south of here. And they were looking at pre-existing homes, and I had them pre-approved. And then they walked into a Pulte development, and she calls me. She's like, "We're buying this house. We're in love with it." And she's like, "So I'm sitting here with the guy right now, and I just want him to tell you what he's offering us, so you could try to match it." I'm like, just just go to them. Like,
Yeah.
it was 3.99%, half price on the pool. So she paid 32.5 for a pool and a cage, and they gave her $40,000 to go towards closing costs.
Yeah, look, guys, this episode is not designed to be a buy a new build home,
No,
but
but it's this reality, right?
like
It's
right now they're so worried about liquidity and keeping these behemoth builders running that they're prepared to give away the kitchen. So if you can get 3.99% with your closing costs and half the pool paid for, guys, go for it. Like Mike will get you on the refi, Mike will get you down the line.
yeah. And I don't get, I mean, people call me that I have pre-approved and like, we're so sorry. And I'm like, why are you sorry? Like,
Yeah.
this is a good opportunity, right? And not everybody's going to buy new construction. There's still a lot of pre-sale homes going on. I got 8 new loans in right now that are all pre-sale, homes. Um, yeah, we're getting busier. It really started looking like it was going to get busy, and then everything happened over,
And then we might have
over the,
bombed the nation.
then we had abomination. Yeah. And once that
So
happened,
so
continued.
other than bombing sovereign states. What do most buyers get completely wrong when they first sit down and talk with you? What is it? What is kind of either the biggest misconception that you have to kind of clarify for, or the biggest mistake they make going into the buying process?
The biggest misclarification is what they think their credit score is, because everybody gets these free credit report.coms, or they get these Citibank offers a free credit report. Those are always wrong, and they're not wrong, they're just a different scoring system. Like my mortgage company and every other licensed mortgage person, we all use the same scoring system.
And
It's
for
a lot more.
clarification, what is it?
It's I don't even know. I don't even know what they
Is it,
call our scoring
is it like
system.
a FICO 4, FICO 8, or something like that?
Yeah, it's got some code behind it, but we all have to use the same thing. It's not the same one as a car dealership. It's not the same one as freecreditreport.com. We all use the same one to keep us on an even playing field. And it's always worse than what, like, you come to me and I play your credit and you're a 640. You go to a car dealership, you're like a 790. Like, you walk out of there feeling great. You walk out of my office feeling like dirt. You walk out of the car dealership feeling fantastic. Um, so that's the biggest thing. And then just watch your spending, and don't, if you're co-signing for your kids, that's great. Like, if you're a parent, you're co-signing for kids as a non-occupying co-borrower or for a car, make sure if the kid's actually truly making the payments, they don't write a check to mom and dad. They write a check directly to the car payment company and track it for 12 months and get it on time, so then I can omit it from my payments. The
Okay.
second you go, from your daughter to Gavin, and then Gavin makes the payment, Gavin, you're responsible for that payment, and it could affect
Okay.
your debt ratio.
So look, we asked you that question because I kind of wanted to to jump into the mortgage side of the world, because obviously this is where you play. This is where I kind of
Mhm.
hand people off to you and kind of hope for the best. Because I'm not interested in getting my MLO. I don't want to become a mortgage. I'm quite happy just being a realtor. So when you look at the biggest factors, like from my perspective, the one thing that everyone's talking about is the obsession with the rate. I
Mhm.
think I think the online sources have kind of talk about the mortgage rate so much now compared to years gone by.
Yep,
How does that impact you? And I know it can have a huge impact on affordability. Um, but when you're talking with someone who thinks they might have a great credit and they've seen Zillow say with a 720 you can get this rate, how does it work in reality?
I'm gonna open up my other computer and my other screen so I could put in a little scenario. Um, like this guy, let's see if I just do average sale price here is probably 425, right?
Yeah, about that.
20% down. I mean, rate isn't huge. Product is huge, right? If you want to, conventional FHA, VA, those are the good guys, right? You jump into that non-QM realm and you're getting into that 8, 9%. That's where you're talking about a big difference. You're looking at a $340,000 loan, which is probably my average size loan size right around here. 7% interest, 2260 is your mortgage payment. If you end up getting it at 6.5, it's 2149. So it's $100 difference,
So that half
$110.
percent of the $400,000 purchase is $100 a month.
It matters. I'm not saying it doesn't matter, but it's not life changing. If
No,
it was,
but
if it ruined your debt ratio,
yeah.
like if your debt ratio got bumped up, then we look into things like, all right, let's try to find a way to get your homeowner's insurance lowered a little bit. Let's try to pay off something off your credit report. There's ways around it to try to make it work. If you're doing PMI, we can do upfront PMI or lender paid PMI, things to lower your total payment. All those little things help.
So and this all plays into kind of the question about what buyers get wrong. I think what I found is I have a buyer come to me with a pre-approval of up to $450,000. And I'm like, okay, let's go look at $450,000 homes. It
Mhm.
doesn't take into consideration that this is a new build home or it's in a newer build development. And you got CDD and you got HOA and you got taxes and you got insurance. And all of a sudden, what you were planning on spending on your mortgage is now being dwarfed by insurance and CDD and HOA and becomes
Mhm.
unaffordable. And I think that is one of the mistakes that I see from buyers. And we spoke about this on our very first episode of not spending your full pre-approval and maxing
Oh
out your
yeah.
budget because prices change on different things.
The kiss of death is, and I get it from, I sit inside of the same office that you're in a lot of times. So I know a lot of the agents that are in your office, and there's a lot of newer agents, right? People that haven't been in the business too long, and they all say the same thing. What's the maximum he can go to? If I say, hey, Mr. Jones called me up, thank you so much for the referral. He put in $250,000 home. It's his first home, right? Um, that's a comfortable level for him. It's a comfortable range. Listen, we all get paid on dollar amount, right?
Yeah.
Um, but I'm not going to push somebody as high as they can go so I can make an extra $64, but what's the highest he can go? I'm like, well, that's a dangerous question because if 300,000 is the highest he can go, and that puts his debt ratios at the max, but then you go ahead and you find him a condo that he falls in love with, and it's got $485 HOA fees. But guess what? Now his max just came down. So it's really a blend. Like I tell people, send me the houses you're interested in looking at, and I'll run it through the system. Like a $300,000 house with $4,000 taxes is a much different payment than a $300,000 house with $6,000 taxes and a
And
$125
HOA as
HOA
well.
fee. Yeah.
Which is why I've always kind of spoken with my buyers, okay, work out what you want to spend monthly on your mortgage. Now
Hmm.
take into consideration what you might be paying in taxes and insurance and add that together. And is that comfortable for you? Because if you want to buy a house at 350 at a 6.5% rate, and your payment comes out to $1,900, but then you've got an extra $600 a month in taxes, your insurance is another 400, and HOA is another 100 on top of that. Now you're pushing up towards $3,000. And can you
Yep.
really afford that $3,000 payment?
Yeah, you don't
I
want to
think,
be eating rice and beans and hot dogs every night for dinner.
well, I
Maybe
said
just a
ramen noodles and ice cube sandwiches.
ice cube sandwiches. Yeah. But like you look at Sun City Center, right? You can go buy some of those places down there for $280,000, but some of them have $800 HOA fees
Yeah, I
a
mean,
month.
Regency is a $3,000 joining fee, and then you pay your monthly HOA on top of that.
Yeah,
So it
they're
can,
crippling.
yeah, and it's why people are selling them and they're sitting on the market. Yeah, look, this 3 bedroom, 2 bathroom looks fantastic, but there's a reason it's been on the market for 280 days.
Hmm.
And sometimes it's because those HOAs are so crippling for people who are moving to kind of, and they're mostly in retirement communities, they're 55 and above, and they can't afford that extra seven, eight, $900 a month.
Yeah, yeah. It's interesting. It's a funny market. And Florida is different. I feel like Florida is different than up north, right? I mean, taxes where I was from, everybody was roughly around the same. The house prices were about the same, and you didn't have HOA fees where I was from. There was
No,
no
HOA
HOA
was a
fees.
new one for me.
Yeah, and then CDD on top of that, it's another whole world, right? And
Hmm.
so but it's stabilizing. I think we're going to have a good second half of the year. I do. I think it's going to be a pretty big. I think it's going to be steady. I don't think we're going to light it on fire like everybody thought we were going to do. Um, but I think it's going to end up being a pretty decent year.
All right, so if you think it's going to be a good year, this is probably a good time to talk about maybe some of the down payment myths. Look,
Hmm.
one of the things that drives me batty from a listing agent perspective is this 1% down payment on your to secure a home in escrow. Like that just doesn't fly in New Jersey at all. Like if you're 20% conventional mortgage and you're putting 1% in escrow, nobody's accepting your offer. But here it seems to be kind of
Everywhere.
par for the course. So from a purchasing point of view, like there are a whole load of down payment myths out there. And I know some loans will allow you to use down payment assistance through things
Hmm.
like Florida Bond or Hometown Heroes. Like when you look at kind of specific programs, whether it's on a FHA or a conventional loan, what if you were recommending to a first-time home buyer a route down a purchase, what would you send them down? How would you look at that?
I mean, credit score matters the most. If somebody, your typical first-time home buyer that has a 660 credit score, 640 credit score, uh, they're generally pushing their debt ratios probably a little bit further than they should because they may not be making the money that they're going to be making in 5 years, but they want to get into a little bit better house or a little safer neighborhood, for their kids or they're going to have kids. Um, a lot of them come to me with down payment assistance because the realtors tell them just go get down payment assistance. It's free money. It's not free money. Um, Plus the amount of time we're going to take off your life to get you qualified or do
Hmm.
underwriting. But hometown heroes or home sweet home or um, any of the bond programs or county programs, if they're giving you $15,000 for assistance, you got to pay that money back eventually, right? So you sell the house, refinance the house, vacate the house. Like if you leave that house, you keep it, you leave it, and you and your wife go buy another house and you rent that house out. The second you switch your homestead, they're going to know and they're going to come calling. They want that money back. And people all of a sudden are like, what money back? I don't know money. Well, you do. You owe $15,000.
Yeah, that actually comes quite a shock to people, especially on the sales side when they see that alta and they're like,
Mm-hmm.
oh, I only had $120,000 left on my mortgage. I'm like, yeah, but you got $15,000 hometown heroes. That has
Yeah,
to be paid when we close. Oh, and then that can impact their next purchase because maybe the proceeds of sale will go towards the purchase of the next house.
right.
So
Exactly.
you've really got to understand what you're getting into from a mortgage perspective. Look, we're concentrating on the Tampa area right now. Are there any Tampa or Hillsborough, Pinellas, Pasco County programs that you would recommend for first-time buyers?
I mean, hometown heroes and home sweet home are great. I'm not a big fan of Essex or Chinoa. Rates tend to be high. Underwriting process is a nightmare. Home sweet home and Chinoa, but normally when somebody needs down payment assistance, I kind of have a way of getting their family involved. Like I try to find out their family life, and then usually in real estate, you don't want to talk to the parents, right? When the kids are buying houses, usually they're the kiss of
We
death.
never want to speak on this side of
Yeah,
the fence. We never
I
want the
know.
parents involved until after closing.
Yeah, exactly. But in this case, when I call the parents up, or if the parents call me and say, "Hey, what are you doing for my son? What kind of program is this?" Right? Or my daughter. And I'm like, well, they're doing a down payment assistance program because they just don't have the money right now to come up with for the down payment and the closing costs and this and that. Um, and I'm like, let me paint you a picture of the repercussions of that. And I tell them that, and they're like, well, how much is it are they getting? And I'll be like, well, it's $15,000. Well, can I give them the $15,000? 9 out of 10 times that happens. Then I'm just doing a straight up FHA or conventional loan. Underwriting's faster. They're getting a better interest rate. Plus, you get seller concessions, right, on your side, which are pretty common down here. So they get a much better loan. They don't have any surprises later on. There's situations where families can't do that, and then we go down to DPA loan, the down
So
payment assistance loan.
let's talk about that. Would you, and again, I know that you're not a financial advisor, you're a
Mhm.
mortgage professional, so you may not be able to answer this question, but given the choice of taking money out of your 401k to pay for your down payment for the purchase of your home, or using a home buyer assistance program, which would you recommend?
I think it matters how much they have in their 401k. The terms of their 401k usually don't get any penalty for it, um, if it's your primary residence. So, I mean, I would go down that path because the underwriting path and the fees, it's when you get another party involved, like the county, it makes these down payment assistance programs less desirable. We do them. They're a necessary evil. They're big down here. I never did any of them
No,
up
I
in
don't
Florida.
remember many in Jersey. I don't think
Well,
I've
the
ever
biggest
used
thing
one
would
in
be
Jersey.
USDA, and that wasn't down payment assistance, but that would be the furthest you go when somebody didn't have a little bit of money, right?
Yeah.
And now USDA doesn't even work down here, but it still works up north. Um,
Wait,
but yeah,
so USDA doesn't even work out in like Plant City and out there where it's very
it
rural?
works from a like a property track perspective, but the the income limit's $81,000, and then the system doesn't like it when it's over like 34% DTI. To make $80,000 and have your DTI only 34%, you
Yeah.
can't own anything else. And
No.
then the way the taxes are and the houses are, I mean, Florida's not like when you and I were kids up in New Jersey. Where I'm moving to Florida, you could buy a house for $34,000, right?
Remember, I was never a kid in New Jersey. This
I
accent
know.
may sound all Summit and Union County, but this is all England.
Well, growing up in New Jersey, everybody would say, you move down to Florida, the jobs don't pay the money, but you pay $31,000 for a house.
Yeah, but
Um,
look, even when you came down 8 years ago, houses were significantly cheaper than they are today.
oh yeah, yeah,
Like
yeah,
8 years ago, you could buy one of these triple creek homes for 250,000. Now they're going for four plus.
yeah. I moved in with my wife. I moved into her house. I think she paid 370 for her house a few years before I moved in, and we sold it 4 years ago.
Now this conversation bit might trigger some millennials and Gen X and
Oh,
after.
goody.
But yeah, look, I had this conversation with somebody the other day. They were complaining that houses are so expensive. And I was like, do you think that I left college and bought my first house the same day? Like I lived with friends for 4 years while I saved up a down payment. Like, and
Yeah.
I don't see that same level of kind of like resourcefulness in this generation of wanting to kind of flat share before they go and buy a house. But we're digressing. Look, one of the things I wanted to talk to you about while I had you on, and I appreciate you for coming on and being my first guest, is at the back end of this. So once the mortgage is processed and it's closed and people have made the mistakes that we try not to get them, they've over leveraged themselves, their taxes have gone up, their insurance has gone up, and now they're struggling and they're starting to edge towards that whole kind of short sale pre-foreclosure kind of like eviction type of thing.
Mhm.
And we covered this, as I said, last week. How does that tie directly back to you? And how does that impact somebody going forward for future mortgages?
So the first thing that happens is if somebody has 2 times 30-day lates on their mortgage, that affects them. So you can't really do a conventional loan or an FHA loan or a VA loan once you go 2 times 30-day late in 12 months. Then you have to wait 12 months and be clean for that long. Okay, that's usually what happens first. Now you can do some non-QM loans, There are some non-QM loans out there that you can do with some 30-day lates. Again, you're not going to get that same interest rate, and you're going to have to put a lot more money down. First thing that's going to happen is like your pre-foreclosure and short sales are kind of like, if you're pre-foreclosure and you end up short selling your house, on an FHA loan, you got to wait 3 years. On a conventional loan, you got to wait 4 years. On a VA loan, you got to wait 2 years. If it's a full-blown foreclosure, it's 3 years FHA, 7 conventional, 2 VA. If it's deed in lieu, it's the same as a short sale, 3, 4, and 2.
So deed in lieu is where you give up the house in lieu of any further payments.
Yep. You say, here's my house, keep all the money.
Yeah.
I'm going to live with Gavin.
No, you're never coming to live with me, but you should be calling me before you get to that point so I can help you not.
I'm going to live with Gavin for a little while and buy a house from Gavin.
Gavin's wife might object to that, but
Depends how big the sale is.
she's definitely the she's definitely the softer of the two of us. So look, guy, look, I think it's as with anything, the sooner you speak to somebody when you're starting to have issues, ideally before that second 30-day late, might be able to refinance you before the list pendants is filed. Might be able to have options for you that maybe you hadn't thought about. And I think where most people go wrong, especially down the when they start to hit financial problems, their head goes in the sand and they let the world pass by and just hope something's going to come out of the ether, and it rarely does.
It's like a medical problem, right? People get medical and they don't want to hear it. They just,
oh, this lump? No, it's nothing. This lump's fine.
It's nothing. Yeah. Yeah.
So look, before we wrap up, and I'll let you get back on with more mortgage applications. What's the one thing buyers should be doing before they call me?
Get everything in line, get pre-approved, talk to a mortgage banker, lender, somebody like me or somebody in my field. Get all your ducks in a row. Let us look at your credit. We can do a soft pull, so it's not going to affect your credit score. That's super popular right now. I only do soft pulls in the beginning, so it won't affect your score and doesn't cost you anything. Let's look at your credit and see what the patterns are. Let's see if now is not the right time. When is it going to be the right time to get in touch with Gavin? Like, when is the time to pick up the phone and call him? Because the realtors love when you call them and say, listen, I've already done it. I'm pre-approved. Here's my letter. I want to buy a $380,000 house. I prefer my taxes to be $6,000 and below. I really don't want an HOA, but if I do, it can't be very high. Like, have all that stuff in order so you can do your job. And then as you do your job, I'll introduce myself to the realtor and, I'll say this, send me over a list of what you're planning on showing Mr. Jones. Right. And then I put him in the system and then I say, here's the different scenarios with his payment after all said and done. He said he wanted to be roughly around here. These houses all kind of fit that mold, and then it makes for a streamlined process for everybody, for the mortgage person, for the client, for the realtor, for the title person.
So let's talk about the clients who maybe have called you to get their ducks in a row and they're having some credit issues. Now, obviously, you've got to be licensed from a credit repair perspective, but do you have anything at Crown that will maybe help somebody whose credit may not be perfect, but you can work with them to kind of get it there?
Yeah, so we have a credit education program that we offer for free to the clients. So as I'm doing a pre-approval for somebody, when I do the soft pull on their credit, say they're off by 25 points. I need a 580 for an FHA and they're at 550. Okay. I look at their credit. If it's something simple that's screaming at me, I'll tell them these are the little things you got to do. But we do have a credit education program where if you upload all your documents as if you're doing a full loan application, your W-2s, copy of your driver's license, your tax returns, your bank statements, and all that stuff jives. And I say, well, if Mr. Jones had a 600 credit score or a 610 or a 580, this would be a great loan. We have a gentleman that runs our credit education program. He's been doing it for 30 or 40 years. He's been doing it forever. I send him over the file. I say, hey, Mr. Jones wants to buy. He's got a complete file in there. Please reach out to him. Let's get him educated on what he needs to do. And it's credit repair without being called credit repair, right?
Okay.
It's in-house.
So it gets you in a position to be able to buy and keeps it in-house, so you keep control. I don't want to say control because it sounds like a bad thing, but it allows you to monitor what somebody who wants to buy a house is doing, and you can kind of like, hey, look, Where are we with this? Where are we with that?
Yeah, and then he gets paid for his services eventually, but he'll end up getting paid out of my end.
Okay,
Like I'll say, hey,
that's fantastic.
you got him buyer, but you got him buyer ready. I'll split my commission with you. Well, I don't know. I don't know what it gets paid, um, but I would have nothing. I would have nothing, right?
Yeah,
If it wasn't for
without
him.
that's a great idea. I love that.
Yep.
That which is why I kind of segued into it. So the recurring segment we have on the podcast, and again, this is only our fourth episode, and I still don't like the title of it, which is from the other side of the table. I'm gonna stick with it until I actually sit down and brainstorm a better one. So, what's the one thing you wish every Tampa area buyer knew before they walked into their first conversation with a mortgage professional?
That they need a job. They need pay
Really?
stubs. You'd be surprised. No, I just wish they. I mean, I like when they don't know a lot because I like educating them. I mean, I do a lot of first time home buyers. I always have, even up in New Jersey. I was in Sussex County, so that was really a first time home buyer area. I have no problem educating somebody on what PMI is. Um, Lender paid PMI, borrower paid PMI, single premium PMI, all the different types of MI programs out there, the down payment assistance. I want them to ask questions. You know,
So in a nutshell, you really want somebody who knows what they don't know, as opposed to not knowing. So
yeah, but
they
as long as they're
come in
willing to
as a blank
listen,
sheet. Yeah, they
yeah,
come
and
in as a
learn.
blank page, and you can help them and all that.
Yeah, and then if they've already owned multiple homes, I mean, I obviously you want people to have all their stuff together. You know, um, we do everything through upload at our company, so we don't ever like fax or email documents anymore. Everything's pretty much uploaded right into your portal. You get your own private portal, and you can do everything right through there. So it makes it pretty good. But it's such an easy process, until you get into the other types of funky non-QM stuff. I mean,
Yeah, well,
non-QM
we
gets
won't
a
touch
little
the
bit.
non-QM stuff. We maybe we'll have you back to talk about those another time. But look, I think from my perspective, I like the idea of having somebody who is open to learning about what is going to be involved, whether it's the mortgage side or the real estate side, like understanding that, I don't know what I'm doing. And no amount of me looking on Zillow, looking on Realtor.com, or watching HGTV is going to tell me what I don't know.
Right.
So again, I love working with first time buyers because they are a lot more receptive to that. I think once you've bought a house or two, you feel as though your shit don't stink and you can kind
Mm-hmm.
of go through it. But things change. Like the way we work as realtors has changed significantly even over the last 2, 3 years. So if you don't think that things are going to change in the mortgage industry or in the real estate industry, and you think you can just do it the way your parents did in '86, like it creates a lot of tension between all the parties and can make either for an unsuccessful relationship where they don't buy a house or at least a fractious one.
Yeah. And rates right now are solid. They're strong. I mean, they're not in the fives. They're never going back into the threes like everybody. I'm waiting
I
for it to
mean,
go
never
back
say
to three
never.
percent. Well, I mean, I don't think anytime soon. Um, but people are out there buying right now. It's a good time to explore it. I mean, there's
I think,
a lot of inventory too.
and just to kind of jump back on I think the rate thing is cyclical anyway. I
Hmm.
remember when my wife and I bought our last home in New Jersey in 2013, we got 375 as our rate. And because we're both realtors, we knew that that was a great rate and we jumped on it. But we were seeing people in the fours and in the mid fives, and obviously if credit was worse, they might go up into the sixes. But you would have that kind of seesaw effect, that kind of roller coaster, kind of like some years it's going to be higher, some years it's going to come down. I think the unnaturally low rates caused by COVID is where everyone feels as though we should have been for the rest of eternity. But
What
given
fun
your,
would that be?
yeah, I would hate to have easy transactions and just make money after money. I want to
You'd hate
spend
to
my
write
time.
offers without driving somebody around the 47 homes.
I just YouTubing 17 homes and having them bid on all 17 on the off chance one of them might fall. Yeah, I don't miss car. I was busy in COVID because I'm a young, healthy male in a predominantly older industry. So I was doing a lot of work in COVID and a lot of video showings, a lot of kind of sight unseen purchase offers. I don't miss those days.
I'd
I
have
like
70, 80 loans in at one time. It was mind boggling. It was
All right,
mind
well, Mike,
boggling.
look, I know you're busy. I know you've got eight new ones on the go right now. Thank you so much for being the first guest on Tampa Real Talk. I really
Oh,
appreciate
I
it and
loved it.
really
You
value
know,
our relationship together. Um, so, ladies and gentlemen, that was Mike Longman. Thank you very much, Mike, for hanging out and talking with us. Look, I don't know about you, but for me, I think the most powerful part of what Mike had to say was understanding where your credit is. Not taking Credit Karma and some of the credit reporting portals as being gospel, and really speaking with a professional to see where you stand right now. Um, Understanding what your spending power is great. Understanding where your rates could be is great. Understanding the true picture is amazing. And one of the things I love about Mike is he doesn't sugarcoat it. He'll tell you, look, this rate's going to suck, but we might be able to refinance it in a couple of years. So look, I will work with Mike until one of us dies, probably. Um, he's just straightforward, tells it like it is, but make sure that anything he gives you as a pre-approval, anything that he gives you is going to close. Even if he's got to yell abuse at a vendor down the phone, I've heard it. Trust me, it happens. So yeah, understand where you stand right from the start, and the rest of it is going to be plain sailing. If you're looking in Tampa right now and you want to get in touch with Mike, his contact information will be in the comments, or you can reach out to me directly. We'll get you pre-approved one way or another. Looking into the future, we have episode 5 coming up next week, and we're going to touch on what we talked about in episode 1 again. In episode 1, we spoke about terrible things that your agent is doing right now that is stopping you from selling your home. Well, I'm going to flip that on its head, and I'm going to show you what we do as professionals that make sure that your home, when it's ready to sell, sells for the most money possible in as quick a time as possible with as little stress to you as possible. And look, I'm going to thank my old boss at Remax in New Jersey for those 3 points. Love that explanation. But seriously, whether it's professional photography and videography, whether it's marketing properly, whether it's the sales side of things that a lot of agents fail at, I'm going to show you exactly what we do as realtors in the area, those of us who know what we're doing, to get your home sold as quickly as possible in the greater Tampa area. So stay tuned. Catch us next week, Thursday at 4 o'clock, and I'll see you all then.